Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Let's bring in Jing Liu, Chief Economist for Greater China at HSBC, to take a closer look at China and what we might see from the big shopping festival coming up, the 618 festival, and also the general outlook. So we talk about that give and take. Here's China kind of giving Tesla something. Why?
So actually, I think after the pandemic, the shopping patterns seem to change a little bit. At least from what I understand, people may not necessarily fixate on certain kind of shopping festival to shop, but the discounts, etc., seem to spread out of the year. But talking about the 618, we already see on the internet platforms, different kind of e-commerce start the offering discount, price war, etc.
So, Jing Liu, I'm curious, when you look at a festival like 618, is there a big generational gap there? Is this primarily geared toward younger shoppers, and older aged consumers maybe are not as interested in participating? Their focus may be in other areas of the economy, and if they're thinking about what's going on in the real estate market, the housing market, maybe they're feeling a little less optimistic that there is a divide, a generational divide, when you look at the Chinese consumer in the retail environment.
Not necessarily. Right now, China is actually offering some trading, for the durable goods, and some of the older generation also take advantage of this and try to exchange their existing home appliances or even autos into a newer and more energy efficient ones. And talking about the consumption in general, I think here the story is the same in the sense that after pandemic, people seem to rotate to service-related consumption. So we have seen, for example, the service retail sales seem to grow at double the speed of the goods retail sales this year, and last year more or less the same.
Do you think then that perhaps we are underestimating potential growth in China simply because, as you say there, that some of the spending has switched from goods to services and maybe the data doesn't quite reflect it?
Yes and no. I think, to some extent, the traditional retail sales data only includes one type of services. That is a catering services. And there's this new data series, but only dates back to last year, which is the service retail sales. So if we look at, both data series, certainly the service retail sales is stronger. And I said no. I think, earlier on you mentioned that does the property sector correction still drag on people's sentiment? I think that's certainly the case. If we look at the consumer confidence index, that still shows that it's not bounced back to the expansionary territory yet.
So when you consider ways in which the government may try to stimulate the economy, we talk a lot about the interest rate environment, but I'm thinking of other steps Beijing may look to take to try to get more engagement on the part of the consumer. And I understand the property market is a big part of that story, and they're trying to address that. But I'm wondering if there are other things that you see that would have the potential for invigorating consumer appetites.
I think the current the trading program, where actually if a consumer try to trade in their combustion engine car, they can get up to 10,000 yuan of the credit to purchase a new car. That certainly help. We see that the recent auto sales seem to reflect on that kind of trend. And other than that, I think the big problem is still, if we look at the savings rate of the household, the trend is upward sloping, which means a lot of consumers are still households are still trying to save for their own rainy days. So the government has a lot to do trying to beef up the social safety net. They're doing it probably not as quickly as the market would wish, but they have taken steps on that.
Jing Liu, when I was looking at the data yesterday, I felt that it was quite mixed. It was nice that retail sales had a little bit of a pop, but when looking at the property prices and property investment was weaker than expected, and fixed asset investment was weaker than expected, and also home prices were weak. They were actually negative. But that doesn't necessarily tell the whole story, because you can understand how prices, it's not prices. We want to see sales. Okay, so what do we know about actual property sales?
Exactly. Yeah, I agree with you. I think in China, in particular, during the rallying days, we have seen lots of local government impose different kind of price controls, usually setting the price ceiling of new homes below the market price. So, from that perspective, it probably is more informative to look at sales. And when it comes to sales, I think it's kind of interesting. We read the headline news saying that the new home sales are still down double digit. But if we look deeper, there's different type of new homes. One is completed new homes. The other is pre-sale. And in China, pre-sale is a dominant mode of new home sales. And we see the clear contrast for the completed new home sales. It's already double-digit growth, but for the pre-sale new home sales, it's still double-digit contraction.
All right. Does that mean we're going to get more support? Will we get more support from the PBOC?
Yes. I think, here what's lacking is still some potential household hesitate because they don't know whether they get what they're paying for. We need definitely more help, not just from the PBOC. I think in general, we need the kind of the backup from the central government to ensure the home buyers either they get what they are paying for or they get a refund if there's a default from the developer side.
All right, let me throw you a curveball. You didn't like the curveball at the beginning, but I'll throw you another one here. It does involve Tesla. It seems like Tesla and Apple are sort of fair-haired boys in China. And, what is it about foreign investment and foreign companies with China? Does it have favorites like Apple and Tesla?
You mean from the government perspective or?
Policymakers,
general
government.
Sentiment. I think right now the Chinese government is very eager to engage the foreign, investors and corporate alike. Actually, I was, in a business trip both last week and yesterday to Shanghai. I saw a lot of corporates actually visiting China.
Yeah. Okay. We'll have to leave it there. Jing, thanks so much. Jing Liu, Chief Economist at HSBC on China. Joining us now on the program for a closer look at markets is Andrew Slimmon, head of Applied Equity Advisors, that team at Morgan Stanley Investment Management. Andrew, thanks very much for taking out the time to be with us. How convinced are you at the moment that inflation will continue edging lower and is not about to switch direction?
Hi. Great question. Thanks for having me on. One of the concerns I have is the way inflation is measured, which is month over month, but it's also year over year comparisons. And last year, in the spring, we had very high inflation. So inflation was coming down. But as you got to the summer, the inflation numbers last year got much lower and below 4%. So I think the comparisons for June and July will get tougher year over year, which is why I think Jerome Powell's trying to focus on month over month. But that concerns me that the market has just taken gospel that inflation's coming down. And really, when I think about it as an equity manager, the market's gone up 40% off the October low. It's rallied 7 out of 8 months. We're due for some type of pullback here, and what could cause it. And I think stickier than expected inflation certainly could be one of the causes.
I'm curious about another. I mean, if you're joining us on a day when both the S&P and the Nasdaq hit record highs today, a number of analysts have expressed a bit of concern about how narrow breadth has been and how concentrated the market's leadership has really been. Some of big mega cap tech names, we've talked about it ad nauseum. Is that a concern that you share?
Well, I think you have to be a little careful, because if all you do is look at price action, and I'm not saying anyone does, but a lot of those comments, I question that, because fundamental performance validates it. In other words, yes, the mega cap tech stocks are kind of sucking the oxygen out of the room, but they also have the best fundamentals. They have produced the strongest earnings. They are the most aggressive buyers of their own stocks. So I'm just a little bit cautious on those who say, well, these stocks, it's ridiculous what's going on. It's not ridiculous what's going on. Their fundamentals validate it.
Andrew, we've had a number of drivers here, and some have gotten better here of late. So one might think that at some point money will just naturally, because of valuations, flow out of that narrow band at the top and into some of the others, because you have a secular growth driver like AI. You've got general optimism over the economy. We talked about corporate earnings have been better, and these slightly better than expected readings on inflation, and then the potential for rate cuts later in the year. So that's a lot of positives, isn't it?
Yeah, I mean, we're in a couple weeks, actually more about 4 weeks, we're going to start getting earnings season here in the States, and I think it's going to be strong for a lot of areas, like the big money center banks, insurance companies. A lot of financials are going to report very good numbers, and so I think this narrow breadth will broaden out when the recognition that there are a lot of industries doing well, not just, AI tech related. So yeah, I think that will be good. So fundamental earnings strength has come year to date in areas well beyond just the mega cap tech stocks, well beyond just the AI plays. It just seems like right now that's the focus, but that could shift as we get into earnings season. People always, these, financials are pretty cheap and they're doing well.
I remember back in the day that Morgan Stanley had the cyclical index and the consumer index. I don't even know if they still exist, but the consumer index was oftentimes very useful for getting a read on the health of the American consumer. And we've got this retail sales data that is due this week. How are you feeling about the buying power of American consumers? Is it beginning to fade a little bit?
The U.S. consumer, clearly, I've listened to so many conference calls of retailers, and what's clear is companies that were aggressive price takers, that raised prices the last couple of years, whether that's coffee or hamburgers or whatever, they're the ones that are suffering. But the companies that have kept prices low, the big box retailers, they're not suffering. So I think it is the consumer not weakening, just pushing back on the higher prices. And that's actually really healthy. And it tells me that the consumer isn't just willing to take any price possible. So I'm not sure it's weakening. It's just becoming pickier.
That's how you get inflation down, is when, higher prices. That's the way it's supposed to work, so it's a good thing. But listen, Andrew, I mean, one of the possible negatives for sure is just the sheer weight of debt and deficits. That's a major concern and could come home to roost. The only problem is it's a little bit like not moving to Southern California because of the big earthquake that might be coming. Now, I know that might sound cute to you, but I think you get the gist of the question. I mean, is it happening anytime soon?
Said another way, I've been running these strategies for a long time, and it's the number one question I've gotten the last 15 years. And if you were underweight equities because you're worried about the deficit 15 years ago, I wouldn't be around. So I know the deficit is an issue, but I look at the dollar and say, well, if it was a big issue, the dollar would be weakening. If it was a major issue, Treasury yields wouldn't be where they are; they'd be higher. And so I don't think I'm smart enough to know what the tipping point is on deficits. And maybe it's because it's more commentary on the rest of the world than just the dollar. But it's tough to know when that will come.
Maybe it shows up to a greater degree the closer we get to the election. Do you have a sense of how the election is going to impact market psychology right now, or is it a non-event, basically?
Well, that's a great question, because my belief the last few months have been, if you look at the history of presidential elections, we have the conventions in the summer, and if the incumbent is leading coming out of the conventions, the markets do pretty well because the markets know what they got. It looks like the president's going to get reelected. We know what we have with them, and they like certainty. And if the challengers is leading, well, then the markets weaken because we really don't know what we've got with the challenger. I think the reason why this is a little different is the challenger has already been president. So rightly or wrongly, you know what you got with both these two gentlemen. So on the one hand, I say, okay, so I don't think this presidency is going to affect the market nearly as much as it normally does. But I will say this. If the Democrats are elected, you could get a capital gains tax increase, and that could cause a lot of selling after the election.
All right, Andrew, thanks so much for joining us. Andrew Slimmon, Head of Applied Equity Advisors at Morgan Stanley Investment Management. The Reserve Bank of Australia is expected to hold the cash rate target at 4.35% at its meeting today. Joining us now to discuss the meeting is James McIntyre, Bloomberg Australia and New Zealand economist. So, James, is it likely that we're going to hear a lot more about higher for longer from the RBA today?
Look, I think that's the case. I think we'll see the RBA continuing to articulate that they don't see rates going anywhere anytime soon in either direction. We had a little bit of a stronger CPI data for April coming through, and that's likely to keep the RBA a little bit concerned and wanting to make sure that they have inflation returning to target. So it's going to be not much from them at today's meeting, just articulating that they think that they can remain patient, and we'll have to see what they come and do in August, which is going to be the next key catalyst or key meeting when they'll update their forecasts, and we'll get a stronger view from them there, I think.
Australia seems to be extremely sensitive to rates when you look at the real estate component, housing, the rental market as well. When you look at that part of the landscape, how does it look, particularly the rental story?
Yeah, the rental story remains quite acute, quite strong in terms of the very big population surge that's come through. Migrants, international students and working holiday makers coming back after the borders were reopening following the pandemic, and that's created intense pressure within the rental markets of Sydney and Melbourne, the two largest capitals, and the two biggest components of the rental index when it comes to the CPI as well. So there's still a lot of pressure there. Some signs hopefully towards the end of the year that it will begin to loosen up as the migration inflow peaks, which it has done and rolls over, but there's enough there to keep the RBA at bay and keep that inflation pressure high. There's a real two-speed dynamic within the housing market overall, though. The price growth in Sydney and Melbourne has eased off, with affordability, with those high interest rates being very, very effective at moderating repayments and putting a big dent on borrowing capacity, whereas in other capital cities where prices are somewhat below what people can afford, you've still got that strong price going on there. So there's a lot of heat still in the housing market that if they were to indicate that maybe they were done or that rates might move lower sometime soon, you could possibly stoke, and they might not be ready for that sort of dynamic in the economy just yet.
James, higher for longer in the United States has been very much at play. I think it's been 10 or 11 months or something like that that they've had rates at this level. And everybody talks about the lagged effect. The U.S. economy, though, has hung in there pretty well. We did see weaker first quarter GDP for Australia. Tell us a little bit about some of the effects of the lagged effect on the economy in Australia.
Yeah, so what we had in the first quarter for Australia was a 0.1% growth in the quarter. That's what's really interesting there is that Australia's population grew by about 0.4 or 0.5 in that quarter. So really, you've had GDP per capita sliding backwards. And so Australia has really hidden a deep downturn in the economy, the biggest per capita decline in GDP since the recession that we had back in 1990, 1991. And we've hidden that weakness, that impact from the RBA's tightening by swamping the economy with 2.6% population growth. So that's sort of been what's going on, and it's kept demand, and almost actually it's sort of helped firms not have to cut prices so much or allowed them to continue to raise prices. This migration and ongoing demand impulse within the economy. So that's what's going on, but it really is a case of the RBA can be comfortable and needs to be wary on the inflation front, so long as we've got that migration support. But as I said, that peak is in, and if that demand side begins to falter, that ability for the RBA to stay higher for longer could be pivoted from quite quickly.
It's very interesting. Recently, we heard from the Treasurer of Australia, Jim Chalmers, who was saying that he's cautiously confident that maybe the government can bring in a soft landing. Now, I know that that's separate from the RBA, but generally speaking, does it appear as though Australia could be headed for some sort of soft landing?
Well, it really depends on how you characterise a soft landing, right? So we will see the economy avoid a technical recession. But that's because, as I said, that very, very strong surge in growth. So on a per capita basis, GDP is not on a soft landing at all. We're already in a hard landing. You know, with economy, as I said, it's got the biggest graze on its knee since the 1990-91 recession on that per capita basis. So that soft landing, that migration story has really kind of helped deliver that soft landing. Not necessarily anything that the government themselves has done. Yeah. As we move through, though, if the RBA does begin to ease up at the end of this year or early next year, we should see that economy continue to grow. And so by that big perspective, that's a soft landing.
All right, James, thanks very much. And we know you've said that you do expect the next rate move will be a cut. It's just a matter of when. And now we've been chatting with James McIntyre, Bloomberg Australia and New Zealand economist.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.